Live from New York City this morning. Good morning, good morning. Equities fade just a little bit on the S&P 500 off the back of a hotter than expected PPI read. From New York, the countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Live from New York City, we begin with the big issue. Looking ahead to a defining week. Economists looking for inflation to fade. Chair Powell set to sign off on a smaller rate hike. And investors weighing whether this bear market rally has gone too far, too soon.
The market's getting very over-optimistic.
There's a little too much optimism embedded in markets.
We've seen this big rally.
This bear market rally in recent months.
We've rallied so hard off of those October lows.
Then you get a couple bad days like Monday and Tuesday.
They stuck you in probably at the wrong time. They whip you around from sector to sector.
I'm more on the side that there's too much pessimism.
And just when you think you got it figured out, there's another trick for you.
I worry that we still have downside.
We don't think that this bear market is over yet.
Joining us now to discuss is Citi Stuart Kaiser, Morgan Stanley's Jim Karen. Stuart, first to you. Do you think this rally can continue into year end?
Hey, good morning, Jonathan. Yeah, I mean, our view is you do have some upside into year end, at least. Early 2023 is obviously going to be a completely different story. But I think once you get past the inflation print next week and the FOMC, assuming those, aren't way out of consensus, I do think there's some space to the upside. If you look at the degree of risk priced into those two events, it's basically 3 to 4 times the risk priced into any other day in December. So I think when you have that kind of risk premium priced into something, if you get through that in sort of a neutral or inline, type situation, then yeah, I think we can move higher into year end. And again, 2023 is a different discussion completely.
Well, given the risk you think exists in 23, the first question people ask is whether you think the juice is worth the squeeze. Clearly you do. When you say a bit of upside, Stu, how much?
I think you can get back to that 40. I think you can get up to 4,150, 4,200 in kind of an overshoot type scenario, but definitely back to 4,100 at least. And then at 4,150, I think is the number that from market technicals and sort of a CTA perspective makes a lot of sense. It's a level that comes up in a lot of client conversations. So I think 4,150 would be the level we're looking for with, potential for a little bit of an overshoot if people get real excited about Christmas, et cetera.
Jim, I know you think there's a bit of a disconnect here. Treasuries rallying over the last couple of months, crude lower, much lower, sentiment better. Is that a disconnect that you think, Jim, needs to be reconciled somehow, and in which direction?
I think it is. I mean, you have 10-year Treasury yields moving a lot lower, and that generally doesn't give a good signal for positive risk sentiment that's in the market. That's usually a cautious type of a move. But look, I think a lot depends on, some of it depends on positioning, right? I don't think that we can look past the technicals. A lot of the reason why bond yields have moved down is because people have been underweight their duration benchmarks. Many index following investors have been short, and what they've been forced to do is cover. And despite what prices are doing, you're going to underperform your benchmark if you are not matching the duration. And I think many people were underweight their duration. So in some ways, I think that a lot of the narrative is really trying to fit a fundamental picture to what's happening to a technical price action. And there's a disconnect there. And I think that, look, if we get inflation that starts to come down, which I think it will, I mean, clearly we're going to see the pace at which that happens, I think that's going to be very critical. But ultimately, what it tells us is that the Fed is still likely to hike interest rates, 50 basis points in December, probably 50 in February, might do another 25 in March, get up to the 5 to 5.25% rate, but then they're going to hold off. And I think in that environment, bond yields can actually rise a little bit. And depending on what's going on with the demand in the global economy, oil prices look like they've come down quite a bit too, and may have some room to move a little higher.
So, Jim, can I pick up on something? Just the positive correlation between risk and treasuries. That's persisted through much of this year, on and off, but persisted through much of this year. Jim, do you think that can stick into 23 or not?
I think it does stick in the beginning stages. So I think that bond performance and equity performance are going to be relatively well correlated. So, for example, if bond yields are moving higher, it's more, in bond performance is coming down, it's very, very likely that we see a downturn in equity performance. But at some point, that correlation is not stable. Typically, these two asset classes have a negative correlation, meaning if bond performance is good, equities is bad, or if equity performance is good, bond performance is bad. And that creates the diversification. So essentially what I think happens is that longer term correlation, that negative correlation between the performance of stocks and bonds does reassert itself. But I think it's not going to be until after the Fed is done hiking interest rates. So that's probably not until the start of the second quarter of next year.
Stuart, where are you on that correlation between bonds and equities?
Yeah, I think from my perspective, the reason you've seen, bond yields lower and equities higher here is because bond yields are moving lower on the view that inflation has kind of peaked and is going to move down. I think to Jim's point, if you get into the first and second quarter of next year and bond yields are moving lower because recession risks are rising, that's sort of a bad reason for yields to be moving lower from an equity perspective. In that sense, I do think you could see the correlation shift. And frankly, that's exactly the way we've seen folks trading it on the option side, which is in the first half of next year, they're structuring hedges that benefit from yields lower, equities lower, i.e. protecting against kind of a hard landing recession outcome.
Stuart, out of interest then, what would be the pain trade in the first half, given current positioning, going into 23?
Well, I mean, given current positioning, I think if we're 4,100 entering the year, then the pain trade is going to be certainly lower in that sense. I look, the bear case that maybe you're trying to describe is you end up in a situation where leading indicators are deteriorating, and to Jim's point, the Fed is going to stay higher for longer. And in that case, the market's going to say, instead of this soft landing we were hoping for, the Fed is waiting to be, proved right on the inflation side. They remain tight, and I have to increase kind of my hard landing odds. So to me, that is the sort of, kind of worst case outcome. To the upside, sort of the opposite of all those things. But, anyway, I think that's sort of the bear case or the negative outcome you could have in the front of next year. And excuse me, very related to the bond equity discussion we just had.
Well, when it comes to the Federal Reserve next year, Jim, I think the question we've been asking over the last couple of days, and I had this conversation with Cassie Barrow of JP Morgan yesterday, is what's more important for me to focus on right now? What is it going into 23? Is it the next 100 basis points of rate hikes that this Fed is basically going to promise us next week? Or is it the rate cuts that this market is pricing in the back half of next year into 24?
Well, for me, the answer is very clear. It's really for the back half of next year. If those rate cuts that the market is pricing in do not come through, we are not priced for that. So essentially, what the market is saying is that the Fed is expected to start cutting rates in 2023. But here's another disconnect. The Fed is not saying that at all. The Fed is saying that they're going to keep rates high until the job is done, until inflation comes down. So it's really a question of when inflation comes down, which I think it will it stay down? The big risk, in my eyes, for 2023 is what if all of a sudden inflation doesn't stay low or doesn't stay down next year and starts to reaccelerate? Does that then bring the Fed back into their tightening cycle from an already higher base rate? This is something that the market is not pricing in, and this is what I'm worried about the most.
And Jim, I think this is a really important question, but it's not that straightforward. If they're not cutting in the second half, we've got to ask why and what the economic backdrop looks like. And you touched on it just there. Is it inflation persisting, and is growth still robust at the same time? Because, Jim, I think that's the key one for me. Let's say they're not cutting in the second half of 23. No cuts, they're sticking with it. CPI is still sticky. On board, I'm with you, OK. But where's growth in that world, Jim? Is growth soft or still firm? Because the market outcomes on that one, I think, are pretty different.
Yeah, and that's going to matter a lot for earnings and the like. So look, I mean, we could have a slowdown in growth, and that could certainly be, and that could certainly happen. Do we have a hard landing, meaning do we have a recession? Yet to be determined, right? It could be a not so hard landing or a softish landing. But if the Fed is not cutting interest rates in the second half of the year, it's probably because the labor market is still very, very tight and wage inflation is still very high. What the Fed is trying to avoid at all costs is a wage price spiral inflation, meaning that inflation starts to get so ingrained into people's thought process that it lets the inflation genie out of the bottle. It just keeps expectations moving higher and higher and higher. The Fed wants to avoid this at all costs. Powell has discussed this on many occasions. They will act aggressively to stop that. But we're not going to know any of this. We're not going to know any of this until next year, or until the third quarter, fourth quarter of next year, to see how low inflation has gotten to, and are the conditions such that inflation will stay low. And I'll say that over and over, that they'll stay low. So whether or not growth is up or down or slightly strong or slightly weak, I think is secondary for the Fed. I think they're willing to put us into a recession in order to stop the wage price spiral inflation risk.
So, Jim, the last 10 minutes is enough to make anyone run, hide under a rock, put a tin hat on, and stay in cash. Jim, what are you suggesting people do in the meantime going into 23?
Well, look, I mean, cash offers a yield these days, right? T-bills are above 4%. I think that's I don't think that's a bad place to be. That's not exactly, though, what I'm advocating. What I think that what we need to start to look at is really a balanced portfolio approach. Look, you've got equities that have dividend yields. You've got bonds. You've got investment-grade corporate bonds that yield above 5%. You've got opportunities that if we have even a not so hard landing, if we just have a mild recession, I think fixed income markets, and my average duration that I like to look at is about a 3-year duration, can still produce pretty good yields into 2023. So just putting your money in cash, I don't think is the optimal thing. We also have to capitalize on the fact that if there is a slowdown, bond yields may start to come down from some of these levels, and there's some price performance that you can get in there too.
Stuart, when it comes to market calls, what are you advocating for?
I think from our perspective, again, we're sort of bullish tactically into the end of the year. I think as you get into next year, clearly the chief risk indicator shifts from inflation to recession, and the need to, position your portfolio accordingly. I think, the areas we've seen the most interest from clients are obviously high quality stocks, stocks that don't have a lot of embedded credit risk, in case that recession is deeper than expected. And frankly, a lot of interest just in story stocks, a stock that has an idiosyncratic story that can be sort of an all-weather performer, even if inflation stays higher or the recession is deeper than expected. And, I think Jim made a really important point about inflation. And, right now everybody's focused on we're getting past the peak. But if that inflation starts to move sideways, somewhere in the 5s, then, to Jim's point, the Fed is not going to tolerate that. And they're going to remain tight and even tighten further on the view that they need to get that down to a more acceptable level. So with those types of risks in the system, again, I think it's high quality stocks and stronger balance sheet stocks. The flows we've been seeing through our system, frankly, even during this rally, are hedge funds buying quality, buying large cap, and mutual funds doing very similar. So, despite the rally, I think the institutional community is still kind of being pretty cautious in terms of how they allocate for the medium term.
And if Jim's right and that risk materializes in the second half of next year, then that dip and rip consensus view for risk in 23, that's a massive challenge to that. Jim Caron, Stuart Kaiser sticking with us. Equities right now down a little bit by 0.4% on the S&P. About 45 minutes ago, PPI in America coming in a little bit hotter than expected. Equities lower. Yields just a bit higher, as you might expect, at a front end by a couple of basis points. 433 on a 10-year, up by 4 or 5 basis points to 353. Coming up on this program, an inflection point in China.
What's going to happen? Are we going to see a stop and go, or are we going to see a gradual easing?
That conversation up next.
What's going to happen? Are we going to see a stop and go, or are we going to see a gradual easing? It's difficult to say, but how that plays out will definitely define what the biggest market for us is going to do. I can now see that the central government is trying to put some stimulus into that and see if they can restart the economy together with opening up.
China moving away from its long-held COVID-0 approach. A commentary on the Communist Party's flagship newspaper writing, we got through the most difficult moment in the battle with COVID. China has taken the initiative to adapt to changes. The tone shift coming just a couple of weeks after the paper reiterated that China will, quote, firmly implement the general policy of dynamic clearing. Chinese officials now mulling a 5% growth target for next year, and a team at JP Morgan saying it's achievable. They write the following: 23 will be the first year under the leadership of the new economic team. It will also be the transitional year for China's COVID policy shift. Economic growth may receive higher priority. Mike McKee has more. Morning, Mike.
Morning, John. The problem is here, there isn't unanimity on that view from JP Morgan. There's a lot of concern about what's going on in China. They do have to open up at some point. But here's what's happening right now. We're seeing cases skyrocket. And according to the latest figures that we have, we only have about 1% of Chinese people who are successfully inoculated and who have had the disease. So it can really keep spreading. And that's the fear as they start to open up. Bloomberg is expecting about 2 million deaths from COVID. So does that mean, as the Mercedes CEO said, a stop and go kind of performance? That's going to be the question. They're spinning it, certainly. The People's Daily saying we've gotten through the most difficult moment. But then Gita Gopinath, the deputy managing director of the IMF, saying earlier this week that China's economic outlook has darkened noticeably, and the forecasts are not particularly good. The IMF cut China in October to 4.6 from 6%, and she said in January we'll be going lower. So they're not buying the 5% idea yet. ING and Goldman have warned that China reopening will be slow. They're not on board with that kind of growth rate. And the New York Fed's Global Supply Chain Index tightened in November with all those stealth lockdowns in China. So it does suggest that there's problems ahead, not only for China, but for the rest of the world.
Mike, you mentioned Goldman there. Can I just bring you that quote from Goldman? I'd love your thoughts on it. They said the following, quote, the combination of rising cases, some regions loosening policies, the winter flu season, and the upcoming Lunar New Year when hundreds of millions of people typically travel makes it difficult to predict how cases, COVID restrictions and mobility may evolve in the coming months. And Mike, it does raise the question. At the best of times, it's hard to predict the future. How hard is it to predict Chinese growth next year?
It's the old saying, it's difficult to make predictions, especially about the future. It's very hard to do China because we saw the Chinese trade numbers come in poor this week, and we also saw PPI in China fall by 1.5% in the month of November, and that's generally a proxy for industrial production there. So we're not seeing good news out of China right now, and if we do see super spreading COVID events, it's only going to make things worse.
This raises questions about the commodity trade as well. Mike McKee, thank you, sir, as always. Crude is positive today, but on the year, it is negative. Investors weighing the impact of China reopening on oil demand as energy stocks have ripped this year and up by more than 50%. Big difference right now, what's happening with the commodity and what's happening with the equities. Take a listen to what Savita Subramaniam had to say.
Having some exposure to CapEx plays, to cyclicals in the form of energy, financials, to me makes a lot of sense because I don't see demand for energy going away and I don't see supply coming back online aggressively. It's starting to hurt being underweight energy. It's a big enough part of the benchmark. Oil could hit 150 next year. I mean, I think this is an environment where you don't want to be out of energy. And in fact, you want to be overweight energy.
Jim Kerr and Stuart Kaiser back with us. First to you, Stuart Kaiser, your thoughts on the energy patch right now. And if we can just compare and contrast what's happening with the underlying commodity and what's happening with the equity at the moment, it's pretty clear. One's breaking down and the other one is holding up. We've had massive gains this year. JP Morgan's Marko Kolanovic came out late yesterday and said the following. An enormous gap has opened up between energy stocks and the price of energy commodities. With crude being close to flat for the year, the energy segment's still up about 60%. We believe that there is a tactical trade to sell energy stocks. Stuart, your thoughts on that?
Look, I think it's important to separate the commodity from the equity, right? I mean, generally speaking, equity markets don't respond to the front of the oil curve. Most normally, those equities are going to trade off something like a 24-month oil future. So I do think you have to separate which part of the curve is moved versus which part equities respond to. And then secondly, equities have both an earnings and a multiple, right? So, coming into the year, energy was a deep value play, and values really benefited, as yields have risen. So some of that performance has less to do with the price of oil and a lot more to do with where valuation was and how styles and factors and things of that nature, have traded on a year-to-date basis. So, I think it's a tricky trade. I don't really have a strong view. I would say that a lot of folks, coming into the winter heating season, definitely expected oil to respond, much differently than it has. If I'm sitting here today, yeah, I mean, equities on the energy side do look a little rich relative to the price of oil, with the two caveats that I've mentioned before. But, you have the potential that you're going into a recession next year. So it's not completely surprising, to see those cyclical parts of the market, that, could respond negatively to that negative, kind of growth impulse. So, in terms of flows and what we've been seeing, I think folks have taken shots to the upside on China and certainly on energy to some extent as well. But I think you've been better off in the energy equities than you have been in the commodity. And that probably, at least, I think, continues for the near term.
Jim Caron, when it comes to the China reopening, I think over the last couple of years, we were all talking about a synchronized reopening. That did not happen. Jim, how unsynchronized will the global growth story be next year?
Yeah, I think this is a very, very key question. And I got to step back and take a look at the big picture, put my macro hat on, and ask myself the question, will China be in a better economic financial situation 6 months from now or not? And I would guess that they would be. I think the reopening will be bumpy, but over the next 6 months, they're going to do it. They have a directive to grow. It's a command economy. They're going to do it. Can I time it exactly what's going to happen in January and February in COVID cases and things like this? Absolutely not. But sometimes it's the change that matters the most. And if the change is in the right direction, whether they get to 5% growth or 4.6 or 4.5, that I think is good to know, but I don't think it's going to make a difference from an investment and from a trading perspective. What I need to look at right now, what we all need to figure out, is will it be higher? Will it be better than what it is today? And I'm going to make the bet that it will be. I'm not going to be able to time it, but I think directionally I'm going to be correct in that. And then all the things that go along with that, whether it's energy demand or global growth or positive for emerging market debt, for example, or even emerging market currencies, all of those things start to fall into place based on that view.
Hey, Jim, wonderful to get your thoughts. Jim Caron there, alongside Stuart Kaiser, the two of you. Brilliant, as always. Equity futures right now down about 0.4% on the S&P. As I said a little bit earlier, PPI came in just a little bit hot. Equities just a little bit softer, going into a massive week next week. Coming up, the morning calls, and later, it's the bulls versus bears. Luthold Group's Jim Paulson seeing a new bull market. BlackRock's Kate Moore saying not so fast. Kate joining us around the opening bell. 5 minutes away from the opening bell, equities down by 0.4% on the S&P, down 0.5% on the Nasdaq. That's the price action. Here's some morning calls for you. Let's get you a couple of those calls right now. The first one from Wells Fargo, upgrading its Netflix price target from 300 to 400. The analyst highlighting better content and global connectivity as tailwinds in 23. Barclays raising its price target for Chewy to 35, citing better than expected results across all key metrics amid demand headwinds. And finally, Cowen raising its price target for Broadcom to 555. The analyst citing amazingly consistent execution in results. That stock is positive by 3%. Coming up, more on Broadcom's results around the opening bell, and it's the bull versus bear debate. BlackRock's Kate Moore says, stay cautious. Your opening bell up next. 23 seconds away from the opening bell this morning. Good morning to you. Going into the open, futures just a little bit softer, lower, negative, down by 1/3% on the S&P. On the Nasdaq, down by 0.4%, coming off the back of hotter than expected PPI data in America. The appetizer for CPI down into next week. There's the opening bell. Switch at the board and get to the bond market. Yields look like this on a 10-year, up 4 basis points to 352. 52 in the FX market. Just a touch of dollar strength. Euro dollar down by 0.2%, 105.38 in the commodity market. Crude just whipsawing everyone this year. Crude right now 71.80, up by about 0.5%. About 15 seconds into this, we're negative by around about 1/3 on the S&P 500. No real drama here. On the Nasdaq, we're down about 0.4%. One stock to watch at the open, Lululemon. The stock on track for its biggest drop since September after delivering weak fourth quarter guidance. The CEO saying on an earnings call, the external environment remains challenging with several high volume weeks still in front of us. Abby has more. Hey, Abby.
Hey, John. Yeah, tough report for Lululemon. The stock, as you were just mentioning, reacting poorly. What's interesting, on the surface, it actually appeared to be an okay quarter. They beat both top and bottom line. But when you lift the lid, inventories not just bloated, almost doubled, up 85%. That's really incredible. I'm actually not a Lululemon shopper, but my first thought is I've got to run up to that store on 3rd Avenue and see what I can snatch. But of course, that's going to mean deals. So inventories in the third quarter of 2022 swelling to almost $2 billion. And apparently this, really weighing on gross margins. They weren't so light, but almost 1% light of the estimate, coming in at 55.9%, really moving in the wrong direction over the last year. There was a little blip up midsummer, but overall down on the year. Management, as you were just mentioning, talking about the challenges, but they're also saying that these inventories, the third quarter inventories, it's a high water mark. It will get better. But I think the reason that we're seeing the stock react so poorly, this chart here that we're taking a look at, John, shows Lululemon on the year outperforming the discretionary and the textiles indexes. Valuation at 33 times forward. That's roughly 35% above, say, Nike, Puma, and some of its competitors. Investors wanting perfection in this tough environment. They certainly didn't get it here. They're selling those shares. And now Lululemon about even on the year. All things considered, though, that's a lot better than the S&P 500, down about 15%.
That's a good point. Abby, thank you. The stock lower all morning. Different story for Broadcom. That stock is higher by about 2%. The company giving analysts an upbeat sales forecast, with the CEO signalling corporate tech spending remains strong. On the West Coast, here's Ed Ludlow. Morning, Ed.
Yeah, good morning, John. Broadcom continues to buck the trend of what we've seen in the chip space. Their fiscal first quarter guidance of $8.9 billion in revenue above analyst expectations. And you're right that actually strength in corporate spending is the main message here for a company. Remember, this is a CEO last quarter who called his earnings surreal. Now they're kind of coming to terms with how they're managing a backlog of orders, managing extended lead times, and delivering chips only to the customers that are ready to use them immediately. This is a stock that has outperformed its peers, although it's still down year to date relatively significantly. Of course, there's been a real correction in the semiconductor space year to date. There is some concern going into 2023. Analysts, of course, are excited when you look at the stock this morning about the capital return thesis with this company. But there are pockets of slower growth, and that is definitely in the handset. If you think about Apple and combine that with Foxconn, those are the biggest sources of revenue, and that's a market that Hock Tan CEO would grow in the low single digits, not in the same way that the rest of that enterprise and corporate business is coming in.
Ed, can we pick up on Tesla as well? That stock is up by about 0.6%. I just want to share our most recent up-to-date reporting with our audience. Tesla will suspend output in stages at its Shanghai electric car factory from the end of the month until as long as early January. This according to people familiar with the matter, amid production line upgrades and, Ed, slowing consumer demand. And my question, Ed, for the company at the moment, and we didn't have immediate response to a request for comment from the company this morning, is whether it's more about line upgrades to the production line or more about softening consumer demand. Which one is it?
Probably upgrades. This is something that all automakers do. Tesla certainly has done it each year that the Shanghai plant has been operational, which is not too many years. Remember as well that in the month of January, particularly late January, that is when we have the Chinese New Year, and it's not unusual for companies to use that downtime, so to speak, to make upgrades. That said, the news flow around Tesla and this stock is intense at the moment. There is a lot of concern about the demand picture in China, largely because not just Bloomberg, but many media reports about the pullback in production overall in Shanghai. There hasn't been a clear response from Tesla. And you look at a number of investors reaching out to IR and saying, hey, Can you tell us what's going on here? But in this case, according to sources, it's very much focused on upgrading the assembly lines.
Thanks for that clarification, Ed. Appreciate it. The stock is up by about 0.8%. Right now, equity's down by 0.2% on the S&P 500. On the Nasdaq, we're down about 0.5%. You're familiar with the consensus forming around the economic picture next year. Ugly. Luthol's Jim Paulson saying markets already priced in the damage.
The lows are in. And I think we're starting a new bull market. Strategists are usually optimistic, but they're just pessimistic. And I think if that's wrong and we are past the bear and we have a modest or no recession and starting a new bull, I think the returns could be really pretty phenomenal, something around 5,000 in the coming 12 months.
Kate Moore of BlackRock taking the other side of that. Quote, equities still don't reflect the damage we see ahead. We're underweight. The trigger to turn positive is when the damage is priced and visibility on the damage improves risk appetite. Kate, I'm pleased to say, joined us right now. Kate, how much damage do you think there'll be?
Okay, so John, I just need to be clear because I heard the preamble.
Sure.
I am not what you'd call, a terrific bear at this point. In fact, I still see some opportunity in equity markets, but kind of over the medium term. I think where I'm more cautious in the very near term is that, you can't really make a buy argument on either the fundamental or the valuation side at this moment in time. Multiples have re-rated a little bit higher over the course of the rally. Really, no one knows what earnings are going to look like in 2023. I feel bad for the analysts that have to put out forecasts when the uncertainty factor is so incredibly high. And if you can't make either a valuation or an earnings argument, then most of the sort of opportunity in the equity market is going to be around trading the technicals and sentiment. And there you have to be very tactical. So I just feel like in the near term, we need a little bit more clarity, both in terms of data, maybe a little bit more information on the path of policy, and more concrete details around the macroeconomic environment, not just in the US, but in China, as you guys were talking about earlier, and other places over the course of 2023. That said, John, I need to say this. I do think, just as Jim was mentioning a moment ago in that clip, there's a decent probability that the super bearish economic and earnings calls for 2023 are not going to prove right. In fact, there's a chance that things are more resilient and we'll find some interesting buying opportunities in the first quarter.
Interesting. So what would lead you to believe that at the moment? Is it the incoming information? Kate, what is it that gives you that picture for early 23?
Yeah, so on the corporate side, I would say what I'm really watching and frankly listening to is what companies are talking about in terms of how they're preparing for a recession. We already know that every economist on the street is forecasting a recession. We already know that most CEOs from many of these recent surveys have said they expect a recession in 2023, but that means that everyone's preparing for it. And so we're seeing companies streamline their businesses a little bit. They're cutting excess headcount that's not necessary or places where they overhired. They're thinking about their investment in CapEx plans for 2023. They're getting a little bit more defensive, which means that once the economy downshifts, they're going to be in pretty good position. I would say, John, we never want to bet against the dynamism of the U.S. corporate.
So at the start of the quarter, when you and I caught up, you said it was too soon to have confidence in EPS forecasts next year. Got a sense that that's the same thing right now, Kate, but based on what you've seen recently, has that given you a clearer picture than you had at the start of the quarter?
Yeah, look, we know there's a big gap between what bottoms-up analysts are saying in terms of, earnings and what top-down strategists are kind of pricing in based frankly, a lot on macro forecasts. So I think there's still some room for adjustment on both sides. That said, I do think that companies are going to really work extremely hard at defending their bottom line in the cost cutting, managing higher input costs, managing slower demand and perhaps slightly slower revenue growth. And so I don't think that earnings are going to be catastrophic next year. I actually can envision a world where we're flat to slightly up in terms of EPS.
OK, well, if that's the call, where do you want to add risk right now, Kate, as you look across the equity market?
Yeah, John, there are a couple places that I still like. I know you guys were just talking about energy a moment ago. On the resource side, those inputs into both new energy and, net zero, economy plus traditional energy, I think will be continued to be fairly well bid throughout 2023. The supply-demand balance across both industrial metals and energy, I think, is going to be quite constructive. I think that there are pockets, and this is going to be more idiosyncratic, frankly, in the consumer that are still worth keeping an eye on. And I really continue to sort of do some more work on the software and technology side. Companies that have massively derated, but have the opportunity to really generate significant free cash. I think the technology CEO and CTO surveys have basically shown that spending will be solid throughout the course of next year, even in a weaker economic environment, and benefit software systems and platform.
Okay, you mentioned energy. Just briefly, what do you make of that disconnect, if we can call it that, between what's happening with the commodity price, the price of crude right now, and what's happened with energy equities through this year? One is down and one's up in a massive way.
Yeah, I'm going to echo actually a comment that Stuart Kaiser made a little earlier on your program, which was, the story for energy equities is not just about earnings or just about the oil price. It was also about re-rating. I mean, the sector had been beaten up, multiples had been in the trash, and so there had been some adjustment back to normalcy. I also think we need to remember that energy equities are going to be pricing in, future prices as well as future demand. And I think these companies are looking forward, and we're seeing companies that have had awesome supply discipline and a CapEx discipline and demand that is likely to remain more elevated than people had originally expected when they were expecting a kind of a light switch flip into new energy.
Okay, can I squeeze in the banks as well? Inverted yield curve, people talking about the end of the tightening cycle of the Federal Reserve. Tightening cycle, which, let's be clear, didn't really benefit these big banks in a material way this year. Kate, where are you on the financials into 23?
Yeah, I'm modestly cautious at the moment, especially on the U.S. bank side. I think it really depends on, if the bank is geared towards more the consumer and what segment of the consumer. I think there's probably a little bit more softness ahead in the low-end consumer, even if over the balance of next year they can get a little bit better. The trading, M&A, and sort of overall investment banking activity outlook is pretty murky. And so I'm not sure I'd be taking a lot of additional risk across the U.S. financials at this point.
Okay, I have to say, you've turned out to be way more constructive than I anticipated. Kate Moore there of BlackRock. Kate, fantastic to catch up with you. It always is. Coming up on this programme, winter arrives in Europe.
What I do fear is if the winter does get colder, clearly gas supplies will start to be used up. You could see a spike in some of these gas prices.
That conversation up next.
We've had a mild winter so far, which has been great because that meant gas prices could come down. You didn't get a spike in gas prices in the way that people feared as you started winter. What I do fear is if the winter does get colder, clearly gas supplies will start to be used up. You could see a spike in some of these gas prices. The energy complex still remains incredibly tight.
Cold weather in Europe sending gas demand surging. Germany's network regulator warning the country needs to save more gas. The agency's president tweeting the following: "This should not continue." Germany's economy minister seeking to calm fears of a shortage, saying, quote, "If we manage to continue the energy saving as it's currently done, then we will have enough gas for the winter." The situation in Europe developing as China is pledging to expand oil trade with Saudi Arabia. Team coverage starts right now with Bloomberg's Anne-Marie here in New York alongside Maria Tadeo in London. Maria, first to you. Winter's arrived. Just how bad is it going to be?
Oh, it's right here. And Jonathan, it's cold. And this winter, well, we're going to see the first real cold snap for the season. Europe going minus on Saturday. And Jonathan, I don't know about you, but when it gets cold, usually I like to turn on the heating. But that is the problem this year. Of course, if you turn up the heating, that means you go into storage. If you deplete storage, the chances, the possibility of blackouts increase. And that could send Europe closer to a recession. And that's why you have that warning very clear from the German regulator, we need more efforts. We need to save energy. On top of that, and I think this really encapsulates the mood in Europe at the moment, you have the French president, Emmanuel Macron, also saying there is no need to panic for the time being, but we have to use common sense and be responsible, all of us.
Latest comments on Russia, AMH, from the president of Russia, Putin, saying they might cut crude output. Your take on that?
Well, he said they might, right? So it's still TBD whether or not he goes through with this threat. Putin has said repeatedly that anyone who abides by the West, the G7's oil price cap, which, Jonathan, we now know is set at $60 a barrel, that he will potentially not sell to those people, but also saying that because of this price cap, and they're coming out with a decree, Russia, in the next few days, he says that they might cut their production. But what did we see immediately after this response? We saw oil prices rally. This is the exact intention Putin has. A higher oil price is good for him. With euros trading at $50 a barrel, potentially he could fetch a little bit more for his product.
Anne-Marie, just in terms of the SPR, is that still happening? Are we still selling that down, or are we talking about buying now? Because I get people sending me messages saying, when are we going to refill the SPR? It's not quite clear to me as to whether we've finished selling stuff from the SPR.
Yeah, well, we were finishing around this time, November, December, about the final drawdown. Now the talk definitely is about refilling it. And Amos Hochstein, the president's special advisor, he's really his energy aide, talked about the fact recently on Bloomberg TV that if there's a sustained prices, this level at $70 a barrel, that's when they would be looking at it. But Jonathan, to be honest with you, when you have WTI already around 72, we've been breaking down a little bit due to the macro environment. I think they will potentially wait until those prices are sustained more closer to $60 a barrel, not 70.
One question that we've been asking over the last couple of days, Anne-Marie, and I'd love your thoughts on it, whether OPEC Plus was right to do what it did a couple of months ago. And I suppose that's difficult to answer based on what's happened with the SPR. But based on where crude prices are and how the demand backdrop is developing, was OPEC Plus right several months ago?
I think Riyadh feels that there's a lot of vindication right now that they have in the market, given where prices are. I mean, look where gasoline prices are in the United States. The White House is very quick to always tout that. Right now, they're well below sub $3.50. What we do know from Abdulaziz, the kingdom's oil minister, early on in the pandemic, he really wanted to make sure they were cutting production. And he had this quote, I wrote about this story at the moment as a scoop, but now he goes on and talks about it publicly. He said that if your house is on fire, are you going to use a garden hose or are you going to call the fire brigade? And he would equate that to what's happening right now. That what they did, that 2 million barrel a day cut, was needed in this market.
AMH, do you want the Tadeo exclusive? Would you like that now?
Yeah, she won't tell us. So, Maria, who are you voting?
Can we clear this up? Spain's out of the World Cup. Who do you support now? Have you chosen a team?
I'm not for the final, but we know there's an important game tomorrow. England, France. Everyone is asking me, who do you back? I've done my research. Spain is out. This is completely objective. And I have to say, it's Allez le Bleu. It's the French have it. They have a killer lineup. No chance
for someone sitting in London right now.
I know.
AMH, that's pretty
I could watch Mbappe all day, but I'm going to go with England. Maria's sitting there. I lived there. My last name is British. I'm rooting for England. Maria, I'm a little bit disappointed in you.
And I got a lot of hate already here.
No doubt about it.
I'm concerned.
Maria, great to catch up as always alongside AMH. We appreciate it. Looking ahead to next week, I have no idea what Maria's playing at in London, talking about Allez le Bleu. Let's talk about next week. CPI, the Federal Reserve, an ECB decision, US retail sales, PMI, CPI. Take your pick, Mike McKee. You've got a busy one next week, haven't you?
And you left out the semifinals of the World Cup. I mean, that's going to get...
On Fed decision day, Mike McKee.
Exactly.
Can you have a word with Chairman Powell about moving that news conference?
Bad scheduling time there. It is going to be a kind of a crazy week, and everybody's focused on the central banks, depending on your continent and depending on your currency. But the Fed is going to drive everybody's thoughts. We have a new survey out today that suggests that the Fed is going to raise rates, the terminal rate, to 5%. That's this economist surveyed by Bloomberg. This is not the Fed funds futures market. markets, but look how long they're going to leave it there. All year. Doesn't start to go down until 2024. So the Fed is starting to get its message across. We'll see if that carries into next week and into the markets. We're also looking at inflation forecasts that have inflation dropping fast next year. The question is going to be, does the Fed see it the same way? They were very optimistic in September. Do they still see inflation coming down as quickly into 2023?
Mike McKee, looking forward to your coverage next week. CPI, the Federal Reserve, and a whole lot more. I want to get you some sector price action just briefly on this equity market in front of us, which is only down 1/10% on the S&P. Here's Abby with more. Hey, Abby.
Hey, John. Well, to use your language, not surprisingly, not so much drama, considering that we are just looking at very small fluctuations at this point. We don't have any sector that is moving more than 0.5% to the upside or to the downside. The best sector on the day right now, communication services, up 0.4%, being helped out by some of the usual suspects, including Netflix, up more than 3%. Interestingly, tech, on the other hand, another piece of the mega cap tech silo, it's actually down 0.5%. This, of course, as yields are pushing higher. On the week, though, it's a different story. Lots of drama. We have lots of down sectors. In fact, 10 of the 11 sectors are down. Some of the worst include energy, communication services, and then also, of course, discretionary, John. This is the worst week since November 4th.
Abby, thank you. Looking ahead to next week, I feel like I've been looking ahead to next week for the best part of a month. Coming up, I'll bring you the trading diary, next couple of events to get you into the weekend, and then it's on to the big week next week from New York. This is Bloomberg. 25 minutes into the session, equities down about 0.2%. That's the price action. Here's the trading diary. Coming up over the next week or so, at the top of the hour, we start with UMich Consumer Sentiment Survey. Then we look ahead to the big week. It's US CPI and testimony from FTX founder Sam Bankman-Fried on Capitol Hill. That's all happening on Tuesday. On Wednesday, a Fed rate decision and Chair Powell news conference, followed by decisions from the Bank of England and the ECB on Thursday, plus another round of jobless claims and retail sales in the United States. A big week to close out the year. From New York City, that does it for me. It's time to go to the World Cup and get away from markets for a little bit. Have a wonderful weekend. This was the countdown to the Open. This is Bloomberg.